clear.
Okay,
So
thank
let's wait for a couple of minutes so that more people can join in, and then we can start with the session.
you. Yes.
And for the information of the attendees, like today's session would be around financial shenanigans and investing journey of Swarnashish. And apart from that, any names taken during the conversation will be purely for illustrations and educational purposes. That won't be any sort of buy sell recommendation from either of the speakers. And also, please avoid stock specific questions. So, yeah.
Yeah, and now the standards disclaimers are applied. Okay. I'm an individual investor. I am not SEBI registered. All the views expressed here are personal, and I do not represent any firm, and all views are entirely personal. Any stock related discussions are only for illustration purpose. I may still own those stocks, and the views may be completely biased. So please consult your financial advisor before taking any decisions. Okay.
So, in the want of time, let's start for the day. So, guys, we have with us Swarnashish Chatterjee. He is a bridge junior national champion in the year 2014, and he is very sports loving person. He also loves to play chess and tennis. And he did an official 14-second Rubik's solve at IIT Kharagpur. So today we'll be knowing about his investing journey, and apart from that, a very interesting topic which is very relevant from investing point of view as well as for individual investors, so as to identify the red flags in accounting and all. So welcome, Swarnashish, and any opening note from your end?
This discussion will be about two topics. One is accounting shenanigans, and the other things will be how should one think about investing. I mean, few case studies where about my winners and few about my losers and mistakes. So that will be all.
Great. So we begin with like how investing journey started for you, in which year, and how it has evolved over a period of time. Would be, I mean, we want to know about the investing thought process or framework which you use so as to generate ideas and screen ideas, and then zero in on your investing. So yeah, over to you.
So initially, I started investing in 2017, November end or December beginning. That was a full-fledged bull run going on. So before that, I spent almost 1 year learning accounting, reading Buffett, Peter Lynch, etc. So when I entered the market, I was just unable to find anything cheap. So I realized you just have to buy uh, small caps who are posting good earnings growth, or maybe there is a good story, and I started doing that, and I kept making money because it was all luck, right? It was a bull market, and probably within 1.5 months I made 30% return, and then eventually 2018 happened, and I realized how wrong I was. Okay, so then I started reading more. I understand what is the importance of corporate governance, what is the importance of moat, why just you shouldn't jump in when there is a 2 quarter of good result and there is a hope story behind it. So e- eventually you learn the process and process of evaluation, evaluating the management and the business, and invest in only in solid business models, and your your risk is managed by your position strategy.
You there?
Yes.
Okay, so like Swarnashish, in the last 5 6 years, how it has evolved for you, how you generate ideas, like how you come to know like, that I have to study this and that company.
No, idea may come from anywhere. That may be some very close circle friends give you an idea. That may be because of I read some news article, or I generally don't screen much, but uh, but I don't look at top down view also. I am a bottom up investor, so I am market cap agnostic, sector agnostic. So anything which looks good fundamentally on a bottom up approach, maybe I just go through one con call and one presentation and realize ki it's a candidate. Or initially first you screen, then you go through investor presentation, then you go through one con call. uh, a lot of them may get discarded just by screening. Then few will be discarded after going to the investor presentations and so on. So after reading one con call, they decide ki okay, this is the candidate, and you just read the last 2 years con call if it's available minimum, and at least 2 3 years annual report. If if there is any bad year before that, then particularly that annual report I want to read. See what went wrong and how the management behaved then.
So, like while you do a hygiene check for the companies which you reject, so what all parameters I mean, what are the filters which you use through which you select few companies and reject others specifically? Any two three main pointers which you want to discuss?
Okay, just I will give you one example. Okay, so 2018 was basically bloodbath for small caps. Okay, and there was one company. Uh, it was in October 18. It was up almost 50% up to October. It's a company called GI Eco Products. It used to make uh, basically uh, pellets, or basically it's a biofuel from agricultural waste type of business. It used to make kind of pellets which are supposed to be replacement of coal and supposed to be sold to NTPC. They are claiming that they got an offer from NTPC also, and basically it's a cheap replacement of coal, and their profits were growing 100% CAGR. Okay, and and the story was good enough. And in 2018, being up 50%, where other stocks are already down 50%, so it was a case. So in October 18 and November 18, I tweeted about it. These cash flows are not real. It's it's not real. Okay. And what happened after 6 months? The stock went up 2x, and then the stock has corrected 96%. So what I saw, key the company never met any cash flow from operation. The CFO was always negative. Okay, and so if a company is not making any cash at operating level, it needs support from external capital to survive. Okay, either debt or equity. Now, if it's a small cap burning capital in listed market, getting debt is very difficult. So they were diluting equity, and uh, in 2018 their business grew, but if I see their employee expense, that just reduced. You just cannot do it when it's a labor intensive business. You are just collecting uh, pellets from farmers. Okay, in 2017 their auditor resigned. So there were a lot of signs ki they're just pushing the price because they want to dilute the equity and promoter want to escape the business. And if you see the last 12 months, their last 12 months cumulative sales are negative. How can sales be negative currently after when the stock is down? Because they reported false numbers.
Hello.
You yes,
Yeah, yeah, go ahead.
yeah, and over the next few uh, minutes, I will be explaining all the few examples of what should you look for. I won't give you examples like you should always look for CFO to EBITDA ratio above 70%, or something like that. I will recommend key first, one should have a decent idea about accounting. I wrote a thread from where you can learn accounting, or at least the basics of accounting. Probably I will retweet it tonight. so that it is easily accessible. Basic idea of accounting, and then you go through all three statements and try to read each line of annual report to understand what is happening. Key. Say I will give you different examples. Yeah, earlier in 2018, I used to take names. Key, these companies have done this, but now I have realized I don't have a legal team, so I shouldn't be taking name. So I will just keep giving you examples. Key, what are the things you should check? Okay. Should I continue, or is there any question?
Yeah, you can continue around this. In between, if I have any question, I'll come to you.
Now there are basically two kinds of stuff. One is accounting fraud, and another is aggressive accounting. Okay. Now the GIACO example was a accounting fraud. Okay. And aggressive accounting is something where there is a provision in India's, and you are using that even though it's not the best representation of your business performance. Okay. Now it's a thing which is applicable for good corporate governance also, good or best quality corporate governance also, and very very clean accounting also. Now if you want to just beat the inflation and you are happy with kind of 9-10% CAGR return, you may, or 10-11% return, you may choose companies with very clean and conservative accounting and be happy for rest of your life. uh, and you know those names, right, which are very high quality business run by extremely professional managers, and the CCP type, and there are other businesses also. But if you are aiming for top percentile CAGR, hunting for small cap, micro cap, then you may have to accommodate space in your portfolio for companies with little aggressive accounting. Okay. Now, but you shouldn't get carried away by those numbers. In your mind, you should have the idea ki what is actually happening. Say, for example, Netflix. Okay. Netflix in 2005 used to be a DVD renting business. Okay. It used to be a DVD renting business. Now, so basically, they are buying DVDs and there is a content loaded in it and they are just renting it. Okay. Now, this buying DVD, what kind of expenses is this? Is this a P&L expense or it's a capex? Now, if it is reported under capex, then it doesn't hit your profit and loss. Your earnings will be higher. Your cash flow from operation will also be higher because it will be reflected in cash flow from investing activities. Okay. So, but it has a competitor called Blockbuster, which is probably bankrupt now. So they used to do uh, the conservative accounting. They used to get it through P&L. So their reported numbers were lower. And Netflix did aggressive accounting. Okay, they just capitalized DVD renting expense. So their CFO was higher. Their reported PAT was higher. Now you should be able to understand that Netflix is doing this. That's why its reported numbers are good. It doesn't mean it's a bad company or fraud company. Netflix is probably 100x, more than 100x actually, from 2005. So you should be knowing that. There are lot of examples which I can give. Okay, for example, there is a company which I tweeted about also multiple times. It's probably it's a waste handling company. Okay, it's in waste CNT and waste processing. Now this is a kind of business which Bape keeps saying ki look for businesses which can be run by an idiot, because one day an idiot gonna run it. Now this is a kind of business which anyone can run it, because a waste processing contract you get for 20-25 years. So once you get it, your cash flow is certain. Okay, you in waste CNT contract also you get work for 7-8 years, and municipality are getting modernized and there is a solid business tailwind. But if you go into their accounting, okay, they have a line item called contract revenue. Okay, and which is basically recognition of revenue of capital expenditure done into their debut projects. Okay, and there is a provision in India for doing that. Now, now, in my mind, this isn't a revenue because you are not getting cash flow from that right now. Okay, but what they say ki for the waste processing capex, there is a minimum fee guarantee in future which will start next year, so this is considered as revenue. And last quarter 20% of revenue was that contract revenue only. Okay, so when you are analyzing the company, you should deduct that revenue and think of the business. Key, what is the actual number? So if you just deduct that, their YOY growth number will be reduced and etc etc. So you have to take care of that. And when you are going into this kind of businesses, your understanding should be very good. And this is a company which has a IT rate also. And I think the in the DHP there is some mention of promoter criminal cases also. I think I've given enough information about which company I'm talking about. And so how do you play if you want to first if you want no headache, don't invest. And if you are investing in such companies, it has to be very low capital, very low position sizing, low single digit allocation. Ki if it has a potential to go 5x, goes. If there is any big cockroach comes out, you sell at 30% loss. And uh, that way I think. I Is there anything, or I should just continue?
Right, right. So I just wanted to know, like, which is the easiest thing which can be manipulated, and which are, which can be just like say earnings can be manipulated easily, right? But
Yeah,
and
it's true.
and when it's
It's
case with,
yes, yes, yes. Your voice is breaking.
is it the same case with the cash flows?
I will. Now, cash flows are difficult to manipulate, but I will give you see P&L manipulation. You can easily imagine, right? You just push the inventory into channels and recognize sales and profit where your account receivables is showing up. There may be change in depreciation policy, but I will cover some examples where cash flow can also be modified. Okay, but mainly any CEO who wants to reach the target or push the stock price in bull market, nobody looks at balance sheet. Okay, so it's better to do the murder in P&L and hide the dead body in balance sheet or cash flow. Okay, uh, but there is a there is a popular saying, okay, ki don't even look at P&L, just look at cash flow because it's the most important thing. I don't completely buy it. Okay, because earlier there used to be cash accounting only, and later people moved into actual accounting because actual accounting gives you a better comparison picture compared to past years. Because operating cash flow can be volatile, right? Because sometimes your working capital gets stuck. Some year your working capital gets flowed into operation CFO. I use CFO just to see what are the claims being taken in P&L is being reflected in cash flow statement. Okay, say for example there is one company which I tweeted in 2020 April. There's a pharma company, market cap maybe 5,500 crore now. Okay, it does work in Latin America, Africa, USA. Okay, their account receivable days used to be 10 days. Now it is 100 days. Okay, the management says we have moved into new geography, that's why it has happened, and it is reflected in cash flow statement also. Now uh, I once I saw this, I just didn't like that. The stock is now 2x from the April 20 when I tweeted, but I didn't dive deep because I just looked into the skin and I just didn't like this. I went through probably one annual report and I didn't study it. Okay, now uh, the thing is ki when you understand the business and you understand all three statements, P&L, balance sheet, and cash flow, it's you you won't probably step into accounting fraud. Okay, you will be able to understand ki there is something going on. Okay, you will someday say for WorldCom, they just hided, they just hidden a lot of debt. So if you just see the interest expense is much higher compared to the debt, so that should ring a bell. Okay, and you should also in annual report you should also go through uh, okay your accounting policies. Okay, what is your revenue recognition policies, and is there any change from last year to this year? For example, ki in 2021, financial 2021, my revenue was getting recognized at delivery, and in FY22 my delivery is getting recognized during shipment. So what has happened in 2021, you recognized delivery, say your shipment time is 1 month. So in the current year you are taking 13 months of revenue, because which you have dispatched in the month of March. In last year you were not recognizing those revenues, but this year you are. So probably which revenue we would have been recognized by the end of April, you are taking that also into your revenue this year, and there will be a revenue push, and accordingly uh, your P&L push. Your CFO won't change, but that's okay. If for 1 year there is any issue in account receivables, it shorts up or something like that, I don't worry too much. I just try to find out why it happened. There may be a B2B business, so right there may be some shipment which got delayed from March to April, and and the cash didn't come. So uh, I mean, the cash flow did come in April, and that's why the account receivable shot up. So that may be okay. But over the period, say 5-6 years, if there is a lot of anomalies between your cash flow statement and profit and loss statement, it's a possible red thing. And if the business development is so good, or you have a uh, very close circle friend whom you respect, and he is saying no, I have dig div, it's okay. Then it's worth digging. Ki why this is happening. But if there is any change in accounting policy and that's why revenue is short, you have to take care of that. Doesn't mean ki you just discard it, but you have to reduce the growth in your mind, and you have to understand ki why this change is happening. Is the management is out of growth engine? So that's why this is being done. For example, there may be a company which sells product at 10% discount. So the product price, the MRP is 100 rupees, and it sells at 90 rupees. So your revenue is 90 rupees, and then your expenses come. But in next year, they just change the accounting policy and recognize revenue at 100 and include one operating expense line item of rupees 10 discount. So your revenue gets pushed, but actually it's the same. Okay, what Enron did? Enron had a commodity trading business. Hello, yeah, Enron had a commodity trading business. They just buy some commodity at 100 rupees and sell it at 101. Their revenue should be rupees 1, and and other stuff for handling and transportation and logistics should come as below the expenses. But they just changed it. They just recognized revenue 101 rupees and push their revenue. Like if you just read about Enron for history, you are done. That's like graduation in financial shenanigans. And there is one alcohol company. If you read about its history, last 10 years, graduation in corporate governance done. It's a permanent cash leakage company.
Right, Sonashish. So, like, which one is the easiest to identify, and which manipulations are hard to figure out, and what is the time, like, how long can companies can go on doing these
Okay.
financial shenanigans because before coming to the return?
Okay, so there are two questions I am answering them. One is hard to find out. So there is one of the case of IBM in 1999. Okay, and it was really hard to find out. Okay, what they did, uh, they sold one of their business. Okay, a partial business, the global networking business probably, to AT&T. Okay, now the gain from this business should appear as a separate line item called other income. But they didn't do that. They just reduced their other expense, the SG&A item, by that amount. They just adjusted that amount against SG&A. So what you will see, your revenue growth is maybe 6-7% that year, but your operating growth is 30% up. And generally, one should go through the consolidated accounting note where there should be the adjusting mentioned, but there is nothing in accounting. There in other expense or SG&A, there is nothing mentioned like ki this is from the other income from AT&T. In annual report, there is just only one line which is written ki this is sold to this, and the profit is adjusted again SG&A. And from 1999 to today, the stock return is probably zero. Okay, and when I'm talking about IBM, I should give one example from Intel also. So Intel also, whenever there is some uh, transactions, the acquisition or partial selling of one business, one has to be cautious. Okay, so they sold one of their communication business to Marvel, and money was paid by Marvel, and Marvel agreed to buy a minimum number of products from Intel in next 2 years. Okay, and Intel didn't inform anything, but Marvel in their 10Q revealed that this purchase of products for 2 years will be done in higher price than the regular one, and recognized liability for that, which means Intel actually sold the business at a discount just to have regular income from next 2 years, so that so that so the profit is not gained, profit is not booked under one time stuff. It's just you just get more revenue and those stuff. Okay, and the second one, where how long a company can keep doing it. Okay, so there is a company called Valiant Pharma. Okay, in January 2008, the stock price was around $13. Okay, and they actually hired McKinsey for growth incentives, and McKinsey advised ki there is no point in burning cash in R&D. Okay, for innovation, you just go through acquisitions. Okay, you can just acquire company which are going to file ANDA in next few years, and or NDA in next few years, and you just keep growing via acquisition. Okay, and Pearson joined there as their CEO. Okay, and they kept acquiring companies which also had a little non-clean history, little bit questionable accounting. And acquisition is one of the most interesting stuff. There you can play with a lot of stuff. Okay, say for example, the easy one is you just ask your target company, the company which you are going to acquire, to report a little bit low revenue, so that after acquisition your revenue shorts up. This is like childlike. And what experts do, they just say to the target company, don't accept any payment from customer, okay, for next 1 month until I acquire you. So your account receivable shorts up, and use all your cash to pay all the vendors, your suppliers. So your account payables goes down. Okay, so your account receivable is up and your accounts payable is down. So your working capital is blocked at a very high level. After merging, you slowly normalize, and your CFO just shorts up. Okay, and you just call it synergy. This is a acquisition play. Okay, so if you have the uh, annual report or numbers of the target company, you just can go through that whether there is any anomaly you are finding. Okay, so what Valiant did, they just keep acquiring companies. Okay, for 2008 2015, their stock went up 20x. Okay, 20x from $13 to $62. Now the stock price is $7. Okay, there was SEC investigations and their CEO had to step down, and etc. etc. So this can go on for a long period of time. This stuff, especially with acquisition, it becomes very difficult to understand.
Right. There is a yes, Swarnashish. So there is a popular saying goes by like, I cannot afford the operation, but would you accept a small payment to touch up the X-ray, as said by Warren Buffett?
That's Buffett. Yes, yes, and there is another thing which is very cool way, and key that is say for example there is a company when there is a new CEO joins. You come there and you write down a lot of stuff, that may be inventory, that may be other stuff, so that in future years your raw material expenses goes down, your depreciation goes down, and etc. Okay, you basically create a free reserve, okay, which can be released later period, and you will be able to report smooth earnings. Okay, just think about banks. Okay, there you can just report higher provision 1 quarter, say "Ki this is a one time expense," and your auditors will love it because it's conservative. Your your investors won't have a problem because it's just a one time expense. And for the next 7, 8, 9, 10, 12 quarters, your PCR is at peak. You can just that's your cookie jar. So whatever credit cost you should have reported, you report 10 bits lower, and your investors are happy कि your credit quality has improved.
We lost you, Swarnashish.
I couldn't hear you. Your voice
Yes.
just.
Shashank, you have anything to ask or maybe comment upon?
Yeah, Swarnashi is very insightful session, and thanks for coming in and sharing all your valuable knowledge.
Thank
I just have two questions basically. So first one is regarding the qualitative and the quantitative side of information that you get from, let's say, the behavior of the management, and of course the numbers in the accounting. So how do you marry these two together? Like for instance, let's say you say that the numbers are coming, but let's say there was a previous case on management or something like that. So is it possible, let's say that a management that does not has a very good reputation, but it is uh, you know trying to change that? Is it possible to catch this change in their behavior through numbers? Like for example, there was a famous shoe company, I won't name it, recently that that suddenly showed a really good growth, but had a like not so good management. So how do you deal with these kind of cases?
See, practically, it's very difficult to understand uh, whether they will repeat this kind of stuff again or not. Okay, the way I think it is key, you play with low single digit allocation. When if you this is like an asymmetric bet. If you win, you get 4 5x. If there is any big stuff come out, you lose 30% of your capital, and that's fine. I just think like this here. But sometimes it's noticeable actually there is a little bit of correlation in corporate governance and accounting also. If, so things become evident from earnings call also, ki whether management is saying the truth. If you are following the company for say 4 5 6 quarters, you are able to understand that if there is any opportunity to distribute cash, whether they are doing it or they are doing buyback, something like that. but
Hmm.
but I will never go with very high allocation because
There's a doubt
I
there.
don't
Okay.
want to go.
Okay, I see. And my second question was like, I had few sectors in my mind, like, financials, infra, IT, cap goods, manufacturing, and pharma. So do you like, when you look at companies, since you are sector agnostic, so how do you basically, could you like give some like, key pointers that you look for on the accounting side for each sector?
you want conservative accounting, but I won't say ki unless and until there is a sheer fraud, I will just avoid it because of accounting. But I will keep in mind ki say uh, say there is a depreciation policy changed.
Hmm.
Okay, there is a there is a music IP company. Okay, and they just changed their amortization policy, which is okay, which is in line. But I will remember when I will see the reported profit for next quarters. I'll just remember that it's happening. There's a contribution from that also, which was fine in my opinion. Okay, and for sectors. I will give you a top down view only. There is nothing like in a textile company you look for different kind of accounting tricks than in a capital goods company. Uh, we can discuss the business wise, and
Okay.
the,
Yeah. And just
in banking it's different. Definitely, in banking it's different.
yeah.
You like probably I tweeted this also. In banking is a business where you do everything right, you get 15% ROE. You screw up one thing, you are at single digit ROE. You screw up two more things, you are at negative.
Yeah, I completely agree.
So
It's like, power of leverage, it's a double-edged sword. It
yes,
works on either side. And last question from my side
and the upper side is cap.
would be that which sectors do you find it on the accounting terms like the most challenging to analyze or most difficult generally?
Anything related to percentage of completion, because percentage of completion, what's like there is a project for which it's a thousand rupees project or 1,000 crore rupees project, and there my estimated cost is 600 crore. So depending on my spends, I will consider my completion stage, and and accordingly I will recognize revenue.
So,
There is no way you can understand what's happening there, and you have to just rely on the management.
so that would be like real estate and infra, if I'm right.
Ye- Yes.
Oh, okay. Perfect. Yeah, pretty.
So there is okay. Go ahead,
No, no,
Shashank.
I mean, I was just like, about to hand over the mic to you. And maybe you can also ask Sajal sir. He's here, so would be good.
I
Yeah,
think Sajal sir won't be able to speak.
Okay, okay.
yeah. Sir has asked a question, so which I'll be asking you. So the question is basically from the chemical and pharma sector point of view. So the question is like, what are the probabilistic red flags in stocks that are near their lifetime highs? Are they known only in hindsight? Is there any specific name where there are signs that match past such scams?
Could you please repeat the question?
Okay, so the question is basically around chemical and pharma sector. The question says, what are the probabilistic red flags in stocks that are near their lifetime highs, right? And are they known only in hindsight, or is there any specific name where there are signs that can match such scams of the past?
There was one Indian pharma company where the accounting is little bit of shady. I just I tweeted in April 20. Okay, I just don't want to name it, but I tweeted in April 20. Except that uh, I'm just not very good about stock price picking out. I mean, generally when I think it's peak, literally, I bought Alkyl Lemons. I sold it up to 3x, and it went up probably 3x or 4x more from there. I was thinking it is the picking margin, but actually, so anyway, and in pharma, there are some businesses where you invest in capacity and R&D, and you file an ANDA, and your competition will come in 4 5 years, so that the cash flow from that particular molecule will sustain for 4 5 years only, and you have to keep running the treadmill. Okay, and it's very difficult to generate free cash flow over a long period of time. I just don't like this kind of business where you make one investment, say think of one of the bad sector, okay, textile company, okay, they just come up with a plant, and at least if there is any price volatility of the output, they will keep throwing some cash forever, almost forever. But for a particular molecule in pharma, where let's say ANDA business and competition may come up in 4 5 years, and so you have to keep running the treadmill forever. If competition keeps coming in, so you have to get another new molecule, and then your cash flow will come. So this kind of business, I don't like.
Right. So any names of red flags or probabilistic red flags when the stock is nearing its all-time high?
uh, I actually wrote a thread about selling peak margin and peak multiple. uh, the combination of these two is very dangerous. And you just can do some temperature check. Just tweet a random facts about that stock and see how much responses that it gets. If it is getting 100 plus likes, the street already knows about it. If there is a webinar about that particular stock, you have to be cautious.
Right. Thank you. So Vineet, you can unmute and ask your question, or maybe.
Hi, Ashish. How are you? Great session. Uh, Two questions, particularly one on the financial statements and one on a sector. So specifically, I'll talk about the financial statement first. We have talked about P&L में accrual accounting होती है. It's easier to manipulate and park the dead body in the balance sheet. Have you seen any examples where cash flows can be manipulated? That's the first question. And second is on the accrual account, on the percentage of completion method, where there are some sectors where cash is front loaded to the company for giving the contracts. For example, shipbuilding maybe. So they as and when finish some portion of the part of the ships, they usually recognize that cash into the revenue. So in those kind of companies where the cash is front loaded, or maybe just like a subscription business also, what kind of shenanigans have you seen in those kind of companies?
So the
Thank
first one, I have already given one example regarding how acquisition helps to pump up the cash flow statement. Okay, and there is another thing which I also want to say. For example, there is a business where you are looking at CFO to EBITDA. Okay, that percentage is very low. So the investor relation team comes to know about it, and they just choose bill discounting. I mean, invoice discounting. Okay, so you're just selling your trade receivables and recognizing your CFO. So your CFO improves. But that doesn't mean that the business is improving, right? Because your customers are not paying, and you are just sacrificing your 1% or 2% margin because of that, and your ROC is any way affected. Now think about one thing. They're just giving this bill discounting to a bank without risk transfer. Okay, the scenario completely changes. Probably they will recognize CFO, but you haven't transferred the risk. So it's basically actually a loan against your collateral. The collateral is account receivable, but you are reporting as your CFO. It may always happen. And there was another question uh, regarding what was the second question?
So Ashish, before we move to the second question, I think you're talking about bill discounting and factoring. So isn't factoring and bill discounting used as a efficient cash flow and working capital management rather than naming it as a financial shenanigan?
Vineet,
Wouldn't
your
it be
voice.
Hello, am I audible?
Anything which is allowed under
You
Ind
cannot.
AS is not
Can you
shenanigan.
please
It's
drop
just
and join again?
hello.
Yeah,
Ashish,
Swarnashish.
am I audible or not?
Yeah, I think you are, Vineet. To
Okay,
me
I
you are.
think
Yeah,
Prince is
yeah.
not able to hear me, so probably he
No,
is asking me to
Yeah.
rejoin.
Hello.
Yes,
Anything?
Swarnashish. So
Yeah.
in the Swarnashish, sorry to come in between. In the want of time, Sajal sir have some time constraints. So Sajal sir, over to you. You had a question and 2 cents on today's topic, please. Vineet will come to you after this.
Great, great. Thank you for your time, sir. And yeah, thank you so much. And
No, I
even
came to hear to Swarnashish here. Swarnashish, man, let's speak later. I wanted to hear you out on your part of Financial Shenanigans. I saw your summary of the book and I really, really liked it. So yeah, maybe we'll speak later at some point in time.
thank you, sir.
Thanks. Thanks,
Vineet,
guys.
Vineet,
Yes,
you
sir, I
had
can call you. I can call you sometime.
Sure. Bye.
so Vineet, you had your question with the Swarnashish. Sorry for keeping you waiting for long. Yeah, over to you.
That's fine. That's fine. It was worth a while. Am I audible?
Yeah, yeah, you are.
So, Ashish, we were discussing about the cash flow shenanigans, and you mentioned that the factoring or the receivable selling to some other parties to jack up the cash can be used as a shenanigan. But isn't it a way to prop up the working capital and to manage the working capital better? And which is stuck already in the receivables, and that is, they want to
Yes,
even added bill discounting method, they can use it to free up the working capital.
yes. It's absolutely healthy. If there is any company which is working capital expensive business and trying to grow very fast, it will require working capital, and and bill discounting. It might be one way to free up the cash, but their management has to take a call whether that margin sacrifice is actually margin ROC assertive or not. But what is shenanigan? If you bill discount with a bank without transferring the risk and recognize CFO. So that is basically actually you're taking a loan against your account receivables, but that should have come into your financing activities, but you're recognizing as CFO. Okay. There is one example, I just don't want to name it. Okay. But that is nothing I have been mentioning except the GIOCO stuff, which is a clear case of fraud or 1% beverage. Other things are not something like which is not allowed under Ind AS. Okay, so that is okay and auditor signed it. But just you have to consider what is happening in the business, so that I'm just giving you an example. There is one business which has a 50% CFO to EBITDA, and you are rejecting it. And there is one business which is doing bill discounting and having 75% CFO to EBITDA, and you are accepting it. That cannot be. That shouldn't be true. Just you should know what is happening. There is nothing against any kind of accounting, but you just go through all three statements, and you will know what is happening.
Got it. So
One exercise, I just carry out. You start with you just look at the cash flow statement and take a printout or keep it in somewhere the P&L and balance sheet, and start with the operating cash flow. That will start with probably PBT, and depreciation is added back. You check the depreciation amount in income statement matching. Okay, then interest expense is added back matching. You will see account receivables is being added back or subtracted. You check the balance sheet difference between the first year and second year. So that is the amount. Whenever you are going, same with accounts payable, inventory. Why CFO is not matching EBITDA? Why is the change? It is stuck up in the inventory. Is it stuck up in the account receivables? Or there might be, you will be able to find out, there is some other increase in other current assets, where then you will dig deep, and you will find there is some cash leakage to promoters. There is some loans given to promoter entity or something like that. Then you again go deep into different transactions, and you will probably discover there is a lease rent which is from promoter's wife, and the company is paying something. And whether it is arm's length or not, that you have to dig deep. You should just carry out this exercise, driving the cash flow statement as if it's a problem from your profit and loss and balance sheet. And if something is not matching, then you will know there is probably some non-cash transactions, and that is little bit of scary, non-cash transactions, because that there may be something there. Okay.
Yeah. So I understand all that, Ashish. So second part of my question was on the businesses who take cash upfront and recognize the revenue based on the percentage of completion of the project. Maybe subscription businesses, maybe shipbuilding businesses where the cash is required upfront, and as and when you complete a part of the project, you actually recognize the revenue. Have you seen any kind of creative accounting there?
For the unearned revenue, where they just created uh, a, a unearned revenue part, which is converted into revenue whenever it is required to smoothen the earnings. These are not something which is against accounting policies, just to smoothen the earnings.
Yeah, but that's I was just asking if there is any shenanigan which can be done, because this is a usual practice. You will keep the cash on the balance sheet and recognize whatever revenue you have done for the quarter, and then rest of the unearned revenue remain in the balance sheet as an asset. So
No, no. Microsoft also changes accounting policy.
okay.
Okay. They just change it to recognize revenue recognition upon shipment of software, so that revenue is little bit delayed, and in later period you can just grow it better. Ultimately, for these companies, you have to go through the con call also. The how much reserve revenue is kept there, and how they are going to be in the future, how they are going to be recognized.
Okay, that's it from my side, Vince.
Thanks, Vineet. So, Ashish, would you like to talk about few of your winners and losers, and what learnings the mistakes which you did while as far as your losers are concerned?
Okay, I have done a lot of mistakes, so probably losers will take almost 1 day Twitter space, but still I will try to cover one winner and one loser. Okay, so this was 2018. Okay, and April Apollo was already becoming a giant in the steel tube space. They are already doing 5,000 crore of sales, and they're pretty dominant after the DFT technology. And Sanjay Gupta was managing the company. Okay, so he's a second generation promoter. Then his son Rahul Gupta acquired a company called Bestie Logistics and changed his name into Apollo Tricot, where they started manufacturing, where they will start manufacturing value-added products, Tricot tubes, right? And and ultimately you can understand he is a business in same segment, where they will use the same supply chain, same distribution. And I think Apollo is today, their capacity probably 25 lakh ton, 26 lakh ton. And Tricot at the beginning was coming up with 50,000 ton capacity. And even if I consider 5,000 rupees EBITDA, they're gonna do 25 crore EBITDA for sure. And they are going to increase capacity along the way. Okay, and it was available at 300 crore market cap. Okay, so it makes sense. So I took my initial position, and what I do, at starting I keep my initial positions very low. Okay, single digit percentage, especially in small cap, because things may go wrong. And then during COVID, this the market cap has increased from 300 crore to 800 crore, but their capacity has gone to 2.5 lakh metric tons. So if you just calculate in the Q4 of FY20, they did 25 crore of EBITDA. So then it was almost a no-brainer, and I loaded it, and now it is merged with Tricot, and it's more than 20x for me. And I trimmed it in between. And hello.
Yeah, yes, Ashish.
And there are other ideas also which And Apple Tricot I tweeted in 2018 when I was going through that. Same thing with Deepak Nitrite when the filling capacity was coming in 2018. Okay, and there is another company called FEM in 2020 June. Actually, Anish Munka is a good friend. He just gifted me the idea. It was available at 5 times price to earnings, 3 times operating cash flows. Okay, uh, that I wrote a thread about IX in April 2020 when from March 20 I was talking about it. And this price used to be 45.50 then, and these are few winners and LTTS also. And then I will like to talk about a few mistakes. One of the recent example is Sequent. So first I wrote a thread about Sequent in June 2020. Price used to be probably 85, 90 when I was buying and I was averaging up. I just like the business. Okay. They were.
Ashish, we cannot hear you. I think you need to
Hello.
check. Yeah, yeah, right now we can. Please.
Yes. So I'm talking about Sequent. So from June 20, I wrote the trade and I started buying and kept averaging up. I like the business. So and the uh, price went above fundamentals. And in July 21, I tweeted when the price was around 270, 300, ki there is probably major price dips. I wrote a thread also ki why this is happening, and I sold except regular residual quantity. And my idea was ki Sequent 2.0 is going to be big. Okay. And again in November 21, someone asked me what price I would like to enter again, and I said 150. And I considered myself very lucky. The price fall below 150, and I started buying, and I averaged down. Okay. Oh, now over a period of time, I have realized that their ex-MD Manish Gupta was a storyteller. Okay, and and I bought into these stories, and especially there is it and Arun Kumar probably sold the aluminium to Carlyle at the price of silver. Okay, and now the current MD is probably giving the right picture, Rajaram, and they have done one acquisition also, Tineta, where their price to sales is actually higher than Sequent, and Sequent is issuing their own equity to buy that business. Okay, and I actually sold below 100. Now, this is not an opinion about Sequent. Maybe there is also issue with raw material price and etc. Maybe the business will turn around. This is one of the recent mistakes which I made and lost money. Then then there is another company which is Navin Fruin. So in February, from January to 2020, I was looking at it. So in February 20, they got a contract and it jumped 20%. Price used to be 1100, 1200 back then. And I tweeted ki probably I will never be able to buy that. And it just shot up like anything. It just missed a 4x. Just because I was unable to pay 30p multiple for a great business. Okay, so for me, valuation does matter. And I missed a lot of companies just because of valuation. I didn't agree to pay up. And there is one of the silly mistakes I made. There is a company called VD Specialty. I was going through it March 20, and I tweeted about it. It had phenomenal track record, but in annual report, the management tries to tell about how cheap the stock is. Okay, so I didn't like that. Ki why management should be convincing you to buy the stock, and I didn't buy even though it has a very good track record, and the stock went up 10x. So
Right, right. So, Swarnashish, like you talked about, so when it comes to related party transactions, right? So, what's your take on that? In what lens we should see such transactions? Are they always bad, or there is any way to figure it out that this is within permissible limit or so? I mean, how we can go about it?
if it is less than 1% of revenue, then it is okay. Say your business in crores and it's in few lakhs. There is, see, if you are coming into small cap or micro cap space, there are cash leakages. But is this shameless cash leakage or little bit? For example, some of the vice brother sits on the board as an individual director and takes some fees, even though he's not expert in the field. Or there may be some rent from the promoter family or something like that. Those things are okay. But if the promoter has a uh, entity in the similar space and there is a lot of raw material transactions are happening between them, then you have to be a little bit cautious. Like because I missed Vidhi and etc because of being too defensive. Currently, what I do, if I see the business is too good and it has a 4-5x potential, I maybe allocate 2% of my capital. This is a asymmetric bet.
Right. And like one important question just came to my mind, like when we are spectacle, so in those times we generally, that there are times when we can overlook few things if the company is good as overall, but again when we have a skeptic mind we keep on digging for negatives. So does that impact your investing anyway, or how you manage that?
See, I'm a very skeptical person. For me, it happens in a conversation like someone comes up with a name and I keep giving him the antithesis, and he says like, "Ki, but few weeks ago you told ki that this is a good company," and I'm like, I hold the stock, but keep your antithesis close. Keep your thesis close and antithesis closer. So I'm a skeptical guy, and that's a problem because Apple Tricot I trimmed. Deepak Nitrite, I trimmed. So it's like uh, doing opposite of what Peter Lynch said, right? Ki watering your flowers and cutting your weeds. I sometimes cut my flowers also because I'm a very defensive person. I just don't want to make a stupid bet. If I kept Tricot at a full allocation, it would be a huge allocation. I won't be able to sleep at night. So I I just diversify for my investing experience is less than almost 5 years. Okay, so for the next 5 years, I will keep a diversified portfolio. After that, I will think whether you should just go all in. Diversification is my risk management.
Got it, got it. So how much, you in a single stock, how much allocation, maximum allocation you can go for if you have strong conviction?
There are two kind of buckets. One, when there is a small cap company, but somehow there is a execution track record, or there might be it comes from a good management. Okay, there I probably will go with 2-3% allocation. If they keep performing, I may average up. Okay, and if it is a company, very good company, market leader or dominant franchisee, and going through a very tough time. For example, I tweeted about LTTS in May 2020. The price is to be 1100. There I go about 4-5% allocation. But this strategy may change after 5 years with experience. But at current level, I make mistakes, so I do not pay high price for that. That's why I keep allocations low. I average up later if the thesis is playing out, but initial allocations are low.
Great, great. So, is there anything which I forgot to ask you and you want our attendees to know? Anything you want to, which I missed asking you, or maybe
Uh,
any concluding remarks from your
no,
side?
no, no.
So any suggestions, or if we are to summarize today's session, so few pointers to our attendees who joined late, so how they can go about checking the accounting standards and fishy things in accounting. Yeah.
Just, 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 uh, just go through accounting policies and all three statements, and obviously you just try to match the profit and loss with cash flow statement, key whether it is matching, and there may be sometimes clues in. You just go through the capex. If it's uh, a company where there is a huge amount of computer purchase or something like unrelated expense, you should just frown. Okay, why this is happening? Why there may not be, it may not be necessary, but there is some expenses. For example, if your revenue grows 5% and your operating profit goes 30%, just dig deep. Whether there is a raw material advantage or there is some hidden uh, adjustment there or something like that. And just match the cash flow with profit and loss. You will find most of it, including the investing cash flow and financing cash flow. See whether the capex is being done from internal accruals or they are just raising equity from market.
Right, right. So, thank you so much, Swarnashish, for sparing time. And I know, like in between, we had Sajal sir and Aditya sir, and it
That
lasted
was a great show.
about yeah. So we got many insights from you and sirs also. So great having you today. And the session was recorded, so I'll be placing that over YouTube as well. And the
Thank you.
guys who joined late can surely revisit what we discussed today. And in case if you have any questions with Swarnashish, you can directly DM him or you can tag him so that relevant questions would be answered for sure. And thanks again, Swarnashish.
Thank you for patient listening.
Great, great. So we'll connect again soon. So, guys, thank you for joining. And if you're liking our sessions, so please check out our handles. And if you find the frequency of the content you're looking for matches with us, you can connect with our handles. We invite so many venerated and respected people in the investing community, and surely there are so many takeaways. The only exception is we are not here to look for any kind of buy sell recommendations. All the opinions shared are for educational purposes only. There is nothing against or for any company, right? So the speakers may or may not have any positions, or there is nothing so as to influence anyone. Please take it as a starting point and do your own due diligence so as to be in a better state, because it's your money. Don't lose it on others talks. So with this, I take your leave for today. Thank you so much for attending.
Thank you, Prince, for this opportunity.